Hello, this is Rochelle Agatha, and this lecture is on corporations and stock transactions and how corporations look in the financial statements. So the objectives of this chapter are to describe the nature of the corporate form of organization, describe the main sources of stockholders' equity, and describe and illustrate the characteristics of stock, the classes of stock, and entries for issuing stock, journalizing the entries for cash dividends and stock dividends, and journalizing the entries for Treasury stock transactions. Describe and illustrate the reporting of stockholders' equity. So up until this point, we've been talking about sole proprietors and partnerships, and you've started to see the difference in the types of companies and how they look in financial statements and the journal entries. So the corporate form and structure is a little bit more complicated, and there's a lot to it, and we just touch on it in beginning accounting, and then when you go on to advanced accounting, you spend a lot more time on it. We're going to just briefly touch on stock splits a little bit too. Describe the nature of corporate form of organization. A corporation, if you remember from early on in the semester, is a separate legal entity, and it's distinct from the individuals who create it. So it can acquire its own property, dispose of property, and it's taxed. The stockholders are the shareholders who own the stock of the corporation whose shares of stock are traded in the public markets are called public corporations. So you think of companies like Google and IBM and Apple, they have stock that's traded on the stock exchange, and everybody who owns a piece of stock is a shareholder. Corporations whose shares are not traded publicly are usually owned by a small group of investors and are called non-public or private corporations. The stockholders of all corporations have limited liability. So when you buy a share of Google stock, you're not liable beyond the price of that stock and what it's worth to you as an asset. No one can come back and sue you and your personal assets for something that Google did. The stockholders control a corporation by electing a board of directors. The board meets periodically, and it's established in their corporate policy. It also selects the chief executive. So when you think of the corporate structure, there's a board at the top. That board elects the main person in charge, the CEO, and it usually identifies the corporate structure. Then the CEO would hire all the people that work up underneath him or her. So here's a little picture of the stockholders, and then there's the board of directors. And then there's the officers, and then there's the employees. So that's the typical organizational structure of a corporation. The advantages of the corporate form of structure is the corporation exists separately from its owners. And as we've seen over the last decade, the line is blended, and there's been a lot of cases, Enron being one of them, where the executives of the corporation have really taken corporations down. But in reality, a corporation does exist separately from its owners, the owners being the shareholders. A corporation's life is separate from its owners. Therefore, when shareholders die, the corporations don't go away. The corporate form is suited for raising large amounts of money. It sells shares of ownership called stock, and stock can be transferred. Corporations' creditors usually may not go beyond the assets of the corporation to satisfy their claims. And we're going to leave it at that in this class. When you take finance classes in more advanced levels, you can really get into going beyond the corporation from a legal standpoint. You know, if an officer is not doing what they're supposed to be doing, like in Enron, then those people become personally liable. But for the sake of accounting, that we're going to take it at face value. The disadvantages are stockholders control management through a board of directors. As a separate legal entity, the corporation is subject to tax. Thus, net income distributed as dividends will be taxed at both the corporate and the individual levels. So you have to think about if you get a dividend, then you're taxed as a person, but the corporation was already taxed on that income. So that's why when you hear people say double taxation, that's what they're referring to. Corporations must satisfy many regulatory requirements, very complex compared to a sole proprietorship. Forming a corporation, first step is you fill out an application of incorporation with the state that you're in. Because state laws differ, corporations organize in states with more favorable laws. More than half of the largest companies are incorporated in Delaware. So here you can see some of the big ones. This is just an interesting little fact. Many companies form in Delaware because their laws of incorporation are easier. After the application is approved, the state grants a charter or articles of incorporation. Management and the board of directors prepare the bylaws, which are operational rules and procedures. So let's talk about the costs. Costs may be incurred in organizing a corporation. The recording of a corporate's organization costs are $8,500 on January 5th. So you record that as organizational expense and cash. Objective 2, describe the two main sources of stockholders' equity. The owner's equity in a corporation is called stockholders' equity, shareholders' equity, or shareholders' investment, or capital. So just keep all those terms as being the same thing. The two sources of capital found in the stockholders' equity section of the balance sheet are paid-in capital or contributed capital. Those are the same thing. That is capital contributed to the corporation by the stockholders and others. And then retained earnings, which is where net income accrues. So you have two pieces of stockholders' equity, the paid-in capital, which is the contributed amount when people buy the shares, and the retained earnings, which is the accumulated net income. So here's a little section of the balance sheet where you have your paid-in capital from your common stock. We're just going to start with common stock. And your retained earnings. So this is the accumulated net income from the corporation. This here is what was paid for the common stock. If there's only one class of stock, the account is titled common stock or capital stock. Notice total stockholders' equity is made up of these two pieces. A debit balance in retained earnings is called a deficit. Now remember from our little chart of account and our accounting equation, equity is a credit balance, normal balance account. So if retained earnings has a debit in it, that means there was net loss over net income, and it's called a deficit. Describe and illustrate the characteristics of stock, classes of stock, and entries for issuing stock. There's a lot to this section of the lecture, and honestly, in beginning accounting, just being able to get it from an overview standpoint and understand the basics of a corporation is what is wanted here. The number of shares of stock that a corporation is authorized to issue is stated in the charter, so that's the maximum population that can be sold at some point. A corporation may reacquire some of that stock that has been issued. The stock remaining in the hands of the shareholders is called outstanding stock. So authorized is the total population. Outstanding is what's sitting in the hands of the stockholders. Shares of stock are often assigned a monetary amount called par. Corporations may issue stock certificates to stockholders to document their ownership. Some corporations have stopped issuing stock certificates except on special requests. So par is an arbitrary amount. When you decide how many shares you want to issue as a corporation, you come up with this arbitrary amount called par. Stock will go out onto the stock exchange and it will sell at either greater or less than par because it's an arbitrary amount to start with. Stock issued without a par is called no par. Some states require the board of directors to assign a stated value to no par stock. So in your mind, if you print these slides out, maybe if you're making flashcards, but par and stated value come up pretty much the same when you're trying to calculate how to book the stock. Just remember, par is an arbitrary amount that somebody stuck out there to begin with. Stated is what you have to come up with if you don't issue par stock. Some state laws require that corporations maintain a minimum stockholder contribution called legal capital to protect creditors. Okay, so our original, here's our big circle of our authorized stock, the big total population. Then there's the amount that was originally issued, and anything left out there is called outstanding. Okay, so there's your little diagram. The major rights that accompany the ownership of a share of stock are the right to vote, the right to share in distribution of earnings, and the right to share in assets on liquidation. That's why people buy stock. The two primary classes of paid-in capital are common stock and preferred stock. The primary attractiveness of preferred stock is that they are preferred over common as to dividends. That's why it's called preferred. So here's a little example. A corporation has 1,000 shares of $4 preferred stock and 4,000 shares of common stock outstanding. The net income, amount of earnings retained, and the amount of earnings distributed are as follows. Net income across the years, amount retained, amount distributed. So here's a very high level look at the retained earnings and the net income distributed. Dividends to common and preferred stock. So here it shows the amount that was distributed The preferred dividend always comes first, and then the common dividend after that. And we're going to show how to calculate this stuff. But from a big picture overview standpoint, this is what it looks like when you start distributing income to the different types of shareholders. So let's do an example. Sandpiper Company has stock 20,000 shares of 1% preferred $100 par stock and 100,000 shares of $50 par common stock. The following amounts were distributed as dividends, and they give you the three different amounts: 10,000, 25,000, 80,000. Determine the dividends per share for preferred and common stock each year. Okay, so the preferred people get their dividends first. Okay, they always get theirs first. And then the common dividend, there's nothing left the first year because the preferred people get theirs first. The second year, there's 5,000 left over, and the third year, there's 60,000 left over. So this is from a total standpoint. So let's go back real quick. Notice the years, year 1, year 2, year 3. And when all's said and done, the first year there was nothing to give the common stock people. Year 2 there was 5,000, and year 3 there was 60,000. So that's a big picture overview. The dividends per share, that's just the amount that was given divided by the total share. So in year 1, common stock got nothing. Year 2, they got 5 cents. In year 3, they got 60 cents. Notice the preferred people got more. They always get theirs first. A corporation is authorized to issue 10,000 shares of preferred stock, $100 par, and 100,000 shares of common stock, $20 par. 1/2 of each class of authorized shares is issued at par for cash. So let's do the journal entry. There's our cash. Let me get the whole entry up here. And the preferred stock and the common stock. So notice that they're telling you that 1/2 of each issue is issued out. So the preferred stock is $100 par, and there were 10,000. So there's 5,000 times 100 is the 500,000. And then there were 100,000 shares of common at $20 par, and 1/2 of those got issued. So there's your million. These are equity counts. This is your cash. When a stock is issued for a price that is more than its par, the stock has sold at a premium. When the stock is issued for a price that is less than par, the stock is sold at a discount. So this is what I was mentioning earlier. Stock goes out on the stock exchange, and in this economy that we're watching right now, every day is a different day. And as stock is valued, people want it, it'll go at a premium. If the market's down and nothing's selling, it's sold at a discount. Caldwell Company issues 2,000 shares of $50 par for cash at $55. Okay, so now this is sold at a premium. So this cash always is coming in at the sales price, 55 times the 2,000 shares. The preferred stock always is booked at the par, so 2,000 times the par. And the difference is paid in capital excess of par. Okay, that's where you book the difference. That's where that paid in capital comes in. So here is my preferred stock, and here is that $5 difference times the 2,000 shares. And this is the notation that goes in the journal entry. A corporation acquired land for which the fair market value cannot be determined. The corporation issued 10,000 shares of $10 par common stock that has current market value of $12 in exchange for the land. So the land's going to go on the books at the market value of the stock, the 12 times the 10,000 shares. The stock always goes on the books at par. That's why it has a par. The difference is paid in excess of par. So here's another example of how stock is issued. It's issued in exchange for assets. A corporation issues 10,000 shares of no par common stock at $40 a share. Okay, now we have no par. So we have our cash and we have our common stock issued at $40. Okay, there's no par, so you don't have to worry about the paid in capital. At a later date, the corporation issues 1,000 additional shares at $36. So now you have common stock issued at $36. Okay, as you can see here, you're just recording stock at what it's issued at, and there's no par coming into play here. Some states require that the entire proceeds from the issue of no par stock be recorded as legal capital. In other states, no par stock may be assigned a stated value. So then you're asking yourself, why not just issue a par? Well, I don't know. That's the government for you. Okay, so using the same date as we used for the par, the transaction is recorded as follows. There was the cash at $40, the common stock, and then the paid-in capital. So here you take the difference between the stated value and the no par common stock and call it paid-in capital in excess of stated value. So like I said a minute ago, why not just have par on your stock? But there are rules in place if you don't have par that you have to have a stated value. The corporation issued 1,000 shares of no par common stock at 36. The stated value is 25. So you put the cash on your books at the sales price, 36 times 1,000. The common stock goes in at the stated value, and the paid-in capital in excess of stated value is the difference between the $11 difference times the shares. On March 6th, Limerick Corporation issued for cash 15,000 shares of no par common stock at 30. On April 13th, they issued 1,000 shares of 4% $40 par preferred stock for cash. And on the 19th, they issued 15,000 shares of 4% $40 par preferred stock at 42. So print these slides out so you can make sure you can follow it on your own. We're going to journalize the 3 different entries. Here's the common stock at the $30 on March 6th. On April 13th, they had preferred stock at $40. And on May 19th, they had the preferred stock and paid-in capital excess of par because it sold at 42. Okay, so there's 3 different examples for you. Now we're going to journalize the entries for cash dividends and stock dividends. The reason people buy stock, 1 is they hold it as an asset to increase in value, or 2, they do it for the dividend aspect. A cash distribution of earnings by a corporation to its stockholders is called cash dividend. There are usually 3 conditions that a corporation must meet to pay a dividend: sufficient retained earnings, sufficient cash, formal action by the board of directors. First is the date of declaration. Assume that on December 1, Hyper Corporation declares a $42,500 dividend, $12,500 to the preferred stockholders and $30,000 to the common stockholders. The date of declaration is important. On the date of declaration, Herbert Corporation records the liability because that's the day you're telling the world you're going to pay it. So it becomes a dividend payable and a cash dividend declared. Okay, so you're booking a liability. The second important date is the date of record. For Hyper Corporation, this would be December 10th. No entry is required. This date merely determines which stockholders will receive the dividend. So on the date of record, there's no entry. The third important date is the date of payment. So on the 2nd, they issued dividend checks. So the dividend payable goes away and they pay the cash. So it's just like any other liability, but you have to remember there are 3 dates. The important dates in connection with a cash dividend of $75,000 on corporations' common stock are February 26th, the 30th, and April 2nd. Journalize the entries required at each date. Cash dividends on the date of declaration, cash dividend payable. No entry on the date of record, and an entry when you pay it. A distribution of dividends to stockholders in the form of the firm's own shares is called a stock dividend. So here you're giving out not a cash dividend, but more stock. On December 15th, the board of directors of Hendricks Corporation declares a 5% stock dividend of 100,000 shares, 2 million shares times 5%, to be issued on January 10th to stockholders of record on December 31. The market price is $31 at that date. The entry to record the 5% dividend is on December 15th. Is stock dividend, the 100,000 times the market, stock dividend distributables, the whole 2 million, and the paid in capital in excess of par is the difference. Okay? So you can give a cash dividend or a stock dividend. On January 10th, the number of shares outstanding is increased by 100,000. So here's our entry to record the issue of the stock. So we debit stock dividend distributable and we credit common stock because we actually issued the stock for the stock dividend. Now our common stock has gone up. Let's give another example. Vienna Highlights Corporation has 150,000 shares of $100 par common stock outstanding. On June 14th, they declared a 4% stock dividend to be issued August 15th to the stockholders of record on July 1st. The market price is $110 on June 14th. Journalize the entries. Okay, here's our stock dividend distributable on June 14th. And on July 1, there's no entry. And when you actually pay the stock dividend in stock, your common stock goes up. Journalize entries for treasury stock. Just try to get the overview of this type of transaction. We're not going to go too deep into it because it's more of an advanced accounting. But basically, a corporation on occasion buys back its own stock to provide shares for resale to employees or reissuing as a bonus to employees or for other reasons. This is called treasury stock. When corporations buy back their own stock, it's called treasury stock. So on January 5th, the firm purchased 1,000 shares of treasury stock at $45 per share. It was $25 par. The cost method for accounting is used. Treasury stock at $45 per share and cash because they had to buy it back. They purchased 1,000 shares of their own stock back. Notice you have a new debit account called treasury stock. It's like a contra equity account because you need to keep track of this when you do it. Later, you sold 200 shares of treasury stock were sold for $60 per share. So now you got $12,000, but remember you bought the treasury stock at a different price than what you're selling it for. So now all of a sudden you have a paid-in capital from the sale of treasury stock. So it's just another type of transaction. And you keep track of your treasury stock transactions, the ins and the outs. Then you sold 200 shares of the treasury stock at $40 per share. So now you got 88,000 cash. You have paid-in capital from the sale of treasury stock as a debit, and your treasury stock is credited at the $9,000. Okay. Here's one more example of another treasury stock transaction. So I'm going to just giving you another example that makes sense. So on May 3rd, you had your treasury stock of the 3,200 shares at the $42. Then you had your cash at 2,000 shares at $47, and your treasury stock, which was originally bought back at $42, and the difference is paid in capital from sale of treasury stock. And then on August 30, you have your last entry when you got $40 for the 1,200 shares. So just print these out and make sure that from an overview standpoint, I just want you to see a couple of examples of treasury stock going through the books. Describe and illustrate the reporting of stockholders' equity. Here's a nice example where you can see in your stockholders' equity section of your balance sheet, you have your preferred stock, people, and you actually list the preferred 10% stock, $50 par. You list the number of shares outstanding. Then you show the excess over par, and you get a total preferred number. Then you come down and you do the same for the common stock, and you get a common stock number. Then if you have any treasury stock, you show that as well. And you add up all of your paid in capital. Here's your retained earnings, and here's your total equity. Then you deduct any treasury stock shares outstanding to get total stockholders' equity. So this visualizes all of the transactions that we just did. And if you're a corporation and you have stock, your balance sheet now is expanded to include this information. Using the following accounts and balances, prepare the stockholders' equity section. So here's some information for you. And maybe you could print these slides out and try it on your own, and then you'll see what the stockholders' equity section looks like. So just another example. Here's a retained earnings statement. Okay, retained earnings statement is what we used to think of as the owner's equity section. You have your beginning retained earnings, just like you had beginning capital or beginning partnership capital, plus net income, less dividends, is your increase in retained earnings, gives you your ending retained earnings. Okay. There's some restrictions. Retained earnings available for use as dividends may be limited by the corporation's board. Those amounts called restrictions or appropriations remain part of the retained earnings. So just keep that in mind. There may be restrictions. So here's just another example of another company's stockholders' equity section. One more example. Dry Creek reported the following results for the year ending March 31. Prepare retained earnings statement. So I'm giving you several examples to look at before you try your homework. So here's the retained earnings, beginning retained earnings, plus net income, less dividends declared, increase in retained earnings at the end. Now remember, we said it could be possible that your retained earnings would go down if your net income was a loss, not an actual income. Describe the aspect or the effect of stock splits. I'm just going to cover this very high level because stock splits are very complicated. A corporation sometimes reduces the par or stated value of their common stock and issues a proportionate number of additional shares. The process is called a stock split. So here's a corporation that had 10,000 shares of $100 par common stock with a current market price of $150. The board of directors declares a 5-for-1 stock split. So before the stock split, there were 4 shares at $100 par. After the stock split, 5-to-1, there's 20 shares at $20 par. Your total value at the bottom is 400 in both examples. Okay. Since a stock split changes only the par or stated value, the number of shares outstanding, it is not recorded by a journal entry. The details are disclosed in the notes to the financial statements. Okay, there's no journal entry on the books. So in summary, we talked about the nature of corporations, the main sources of stockholders' equity, the characteristics of stock. We did journalization, and we talked about reporting of stockholders' equity. So just make sure that you print out the slides, you can follow the examples. They should be very similar to your homework, and if you have any questions, let me know. Thanks.